Part of our job is to help clients mitigate risk. And so it's more than just the insurance policy. It's what are the resources that we can bring to the property level to help them mitigate risk and plan for events such as wildfires. A steady hand is someone that you can absolutely 100% depend on to be there when you need them and even when you don't think you need them.
Thank you for joining us for this final session of Bold Predictions 2023. This session will be talking about maximizing your tax benefits. And we have two experts here from CTI that are going to be talking about research and development tax credits and employee retention tax credits, Stephanie and Mitch. But before we go over to them, let me just remind you that this session is pre-recorded. The presentation part is pre-recorded. But the presenters are here in the live chat, so if you have any questions along the way, just put them into the chat and they'll be here to answer your questions. Okay, with that, I'm going to kick it over to Stephanie. Here you go, Stephanie.
Thank you, Kim. Good morning, everybody. So today's topic, a program that we'll be discussing, as Kim mentioned, is the Employee Retention Credit. This program was first introduced back with our very first stimulus package, the CARES Act. So it is a pandemic-related program. Most of you may have heard of it. Some of you may have been taking advantage of it. But today's topic is really to discuss the program at a very high level and how it impacts your industry and the areas of potential qualification if you haven't already taken advantage of the program. The qualification periods begin for the program March 13th of 2020 until the end of 2020. And I'm going to share my screen here. The Employee Retention Credit, refundable payroll tax credit, that is going to offset the tax liability that you have paid on your quarterly 941 payroll tax returns. So it is a payroll tax credit, refundable payroll tax credit is what we're talking about today. The qualification periods begin March 13th of 2020 until the end of 2020 and the first 3 quarters of 2021. In terms of credit amounts, it does differ for each of the years. So I'll start with 2020 first. For 2020, the available credit is capped at $5,000 for each eligible employee. We're going to talk about eligibility next. But regardless of how many quarters the business is able to qualify for, the maximum amount of credit that an employee can generate is $5,000. For 2021, the credit increased significantly, and the available credit in 2021 is up to $7,000 per employee in each of those first 3 quarters of 2021. So $7,000 available credit in Q1 of 2021, in Q2 of 2021, and Q3 of 2021. So to summarize, one employee, if the business is eligible, can generate up to $5,000 worth of refundable credit in 2020 and up to $21,000 of refundable credit in 2021. So very lucrative if the business is eligible. And again, refundable payroll tax credit is offsetting the tax liability that's been paid on those 941 payroll tax returns. So let's talk a little bit about how this is impactful to your industry and the areas of potential qualification that your business could qualify under. So there's 2 tests that the business has to satisfy. One is a revenue test and one is an authoritative test, a government shutdown order test, which we'll talk a little bit more as we move through these slides. But in terms of where your particular industry and where you could see the impacts for this potential credit for your vineyards. So if you had any types of impacts surrounding your vineyards, certain examples of that could be private events. So wedding events, party events, things of that were completely shut down. I know particularly for California, which I reside in California, very heavily mandated state. If you are a non-essential business, we had a strict shelter-in-place order, which means it impacted almost all non-essential businesses. Every non-essential business was impacted in some form or fashion. For your particular industries, these are some of the areas that you would see impacts to your business, the private events, your tours, right? So any types of tours, limitation around that were just non-existent for months, even almost all of 2020, and even going into those first couple of quarters of 2021. Your bottle and barrel events, sanitation costs. When we look at the wineries itself, so your tasting rooms completely shut down for a period of time. Capacity requirements, when you were able to open doors, and if your particular winery was serving any type of food, you had capacity requirements, curbside only pickups to your wine memberships or to anybody who wanted to purchase wine if you had a retail segment to your winery. Also, other areas of that could be the bulk wine. So your wine memberships, right? I know that we had online sales that potentially could have picked up, but nonetheless, your bulk wine sales also could have taken a bit of an impact, on the revenue side. So when looking at your industry and looking for those examples of, what occurred to your business, going back to that mid-March date in 2020, I know we're going on 2 years now since the pandemic, but nonetheless, the residual impact is still there that you're still incurring, whether that be on the revenue side or the cost side. So let's talk about the two ways that your business can qualify. So there's two ways that a business is deemed eligible for this program. I mentioned earlier that the first is through a revenue test. And the business has to satisfy certain declines, and the declines in revenue differ per year. So I'll speak to 2020 first. In 2020, the business has to experience a 50% decline in any of the operating quarters of 2020. And the way that we run this test is we would take your quarterly gross receipts of 2019, and we would compare those to your quarterly gross receipts of 2020. And we would run that test on a quarter by quarter basis to determine if the business is experiencing a 50% decline in revenue in any of those quarters. If the business is eligible in those quarters based on those declines, then you're able to calculate credit for that quarter. Now, for 2021, the threshold for the revenue test was reduced to 20%. We're still utilizing your quarterly gross receipts of 2019. It is the base year to run this test, but now we're going to compare them to your 2021 quarterly gross receipts. And we're looking for that 20% decline, for the business to satisfy a 20% decline in any of those operating quarters. If the business is eligible, then you're able to calculate credit in that quarter. And we run that test quarter by quarter. Now, if the business doesn't meet the eligibility test, then the other test is the authoritative test, the government shutdown order test. And it truly is a facts and circumstance case that is built on whether or not your business was impacted through a partial closure or a full closure. And there's a lot to uncover around that in terms of what constitutes a partial closure, a full closure. And that is really where we would determine and, uncover those areas of impacts. As I mentioned, those examples, right? What percentages of your revenue were impacted due to, not able to host events or weddings, things of that nature. Your capacity requirements, tasting rooms completely shut down for a period of time. I know specifically here in California, Governor Newsom had, the state was completely shut down for a period of time. And we went through waves, if you all remember, where, we were kind of opening back up in the summer, and then COVID, cases spiked again, and then we were shut down again. And then we were open up again, and then we were shut down again. But truly, truly, all orders were lifted in the state of California on June 15th of 2021. Meaning that no orders exist beyond that had some form of limitation around a business, right? Capacity requirements were lifted. You could now operate as normal. So these are the two areas of two tests that have to be satisfied in order for the business to be deemed eligible for the program. And it's either or. You don't have to satisfy both tests. It can be a combination. You could be hitting a revenue test in one quarter and qualifying under an authoritative test in the next quarter. Again, it's determining all on your facts and circumstances during these time periods, which is that March 13th date of 2020 until the end of quarter 3 of 2021. When we look at, the best, in terms of documentation, right? So how do you claim the credit? What's the best source of documentation in order to apply for this credit? So being that this is a payroll tax credit and we're looking at retroactive years, so those returns have been filed, you have paid that tax. So if you are able to qualify and you're able to generate credit then it would require an amendment to be done to that payroll tax return. A 941X would need to be completed in order for you to file it and claim the refunds, is essentially how this program works. Again, you have to have paid payroll tax, paying wages to employees. Now, there are some caveats to the program in terms of other programs or credits that you may have been taking advantage of. The R&D tax credit, which my colleague Mitch Feldman will be talking about next, or more commonly, the Paycheck Protection Program, PPP. Now, initially when the program was created, it specifically said that if a business had PPP, you could not participate in the ERC. But the program has undergone many revisions, so that has since been lifted. You are allowed to participate in both programs. You're just not allowed to utilize the same wages that you utilized for payroll cost on your PPP. So whatever was allocated towards payroll cost, you're not allowed to utilize those same wages to calculate an ERC credit. So you're not allowed to double dip. You can't get a fully refundable loan and use that towards payroll wages and then use those same wages to calculate an ERC. All of that is within this here, the documentation, right? And determining, one, are you eligible? And then gathering the supporting documentation so that you can then calculate the credit. Ensuring that if you are qualifying under an authoritative test, that there are orders that existed during this time period that had this form of limitation or restriction around your business that ultimately ended in a financial impact. Or you're able to qualify under an authoritative test a gross receipts test, where that is a true bright line test where you are comparing numbers to numbers, right? We're comparing quarterly numbers to determine if the business satisfies those significant declines in 2020 and then 2021. The authoritative test is not bright line. It is a true facts and circumstance case, and the documentation is incredibly important to this component of eligibility. One, it's determining were there orders that existed that had this form of limitation or restriction, and then documenting what that limitation or restriction was. Looking at your physical location, what types of restrictions occurred around your physical location, your workforce disruptions. Did you have to furlough or lay off employees? Did you have to make a change in compensation? Did you have to cut hours? You kept employees on payroll, but instead of employees working an 8-hour shift, they're now only working 4, or something of that nature. And then lastly, looking at your operations as a whole and how were you impacted and your ability to even conduct business during this time period and bring in new business during this time period. So a true facts and circumstance case when we look at, the side of the authoritative test and all the supporting documentation that would surround that qualification. Lastly, in terms of 2023, the program for the 2020 quarters, I get a lot of questions of, is there an expiration date? When do I have time to still file? Is there any type of due date? And for the 2020 year, the statutory date in terms of filing, so the last date that you can take advantage of this program is April 15th of 2024 for the 2020 quarters. For 2021 quarters, it is April 15th of 2025. So while you hear those dates and you think, oh, there's a couple of years out, it's a government program. And, the government at the, whim can, sign off on the program and repeal it, put an expiration date on it. As of now, those are the current dates that we have in order to take advantage of the program, but changes can happen. So the sooner you take advantage of it, the sooner that you would be able to receive those benefits. Right now, the IRS is experiencing a bit of a backlog with processing these returns. It's incredibly popular because of the refundable aspect and the fact that most businesses were impacted during the pandemic. So the likelihood of a business being impacted during these time periods is pretty high. Therefore, the IRS is experiencing a bit of a backlog with processing the refunds. Currently, right now, our clients are experiencing about a 4 to 6 month wait time in order to receive those refunds. And that's from the date that they receive your 941Xs. So counting the clock from the date you get those sent into the IRS and they get into the queue for processing, it's about a 4 to 6 month wait for you to receive those refunds. But nonetheless, a program that you should definitely have on your radar, a program that if you're not taking advantage of it and you had employees and you paid wages and had payroll tax, even if you took PPP, you're still allowed to participate in the program or any other credits for that matter, whether that be the work opportunity tax credit, the R&D tax credit. You still are allowed to participate in the ERC. We just can't utilize the same wages that were utilized to calculate those other programs. All of that would be completed in an analysis to ensure no double dipping occurred. Things to be on the lookout for, there's, I've been with CTI now for 12 years. I just celebrated my 12-year anniversary back in December, and I have never seen so many pop-up shops for experts in ERC like I have over these last 8 months. So be aware of that. If you have, I'm hearing it on the radio, you get bot calls in terms of like, you could get up to 27,000 or 26,000 in credit, answer these questions and, 10 minutes will qualify you in a day. I mean, be aware of those firms that are telling you can qualify in a day or they can get you credits in 2 weeks. There's a lot of substantiation that goes into these credits. And while it is a fairly new program, it's been in existence for 2 years now. We don't know what the outcome is going to be with the IRS. We do know that they have hired a significant amount of auditors. They did expand the statutory requirement for a look back on this program from a 3-year to 5-year. Are audits coming? We don't know, but we do want to ensure that your credit is substantiated. So I just want you to be on the lookout for that when you're hearing these claims of receiving your credit in 2 weeks or you're able to qualify in 2 weeks. With that, that is the end of my presentation. I'm going to go ahead and stop sharing now, and I'm going to turn it over to my colleague, Mitch Feldman, who's going to talk a bit about the research and development tax credit.
Well, thank you, Stephanie. Hello, everyone. My name is Mitch Feldman. I'm a tax attorney who specializes in the R&D tax credit. I've been working specifically in tax for about 15 years and R&D for over 10 years. Let's jump into the R&D credit. Many of you may be familiar with this credit as it's been around for a little while. But just to give a quick refresher for everyone, it actually was created back in the 1980s, almost as a sort of a patent credit. The only real way to claim the credit was you had to have a patent. If you didn't, it was incredibly difficult. But back in the early 2000s, they completely rewrote the definition of what qualifies as research and development for this tax credit. What they wanted to do was greatly expand the number of industries and companies that were eligible to claim this credit and really try to spur innovation here in the United States. So they completely rewrote the definition, and you can see it on this screen as a way I've tried to put it into image form. And essentially, it's any time a business develops a new or improved, and I always like to highlight improved. It does not have to be brand new. It can be something that is existing that you're just building upon. But a new or improved product, process, can include a design, formulation, invention, software, or technique. You can qualify for this credit. As long as that development is for one of the permitted purposes that you can see there at the top. It's for improving its functionality, performance, reliability, quality, or even overall efficiency. So what you need to do is basically make a connection between the two. So anytime you're improving the functionality of a design or the reliability of a product, you can qualify for this credit. As you can tell, that's an incredibly broad definition. And like I said, can lead to a lot of different businesses and industries to claim this credit. So very frequently, you'll see manufacturers, engineering, architecture firms, software development companies, those very commonly qualify and take this credit. And although it's not specifically listed in the tax code which industries can or cannot take this credit, again, it's all meant to build and spur American innovation. But a very quickly growing industry I've seen in recent years claiming the R&D credit is the agriculture industry. This can include cattle, dairy farms. I see a lot of poultry, breweries, distilleries, and of course, winemaking. Wineries are claiming the R&D credit. On the next page here, let's basically cut right to it, since this is what's most important. You know, what type of activities do I frequently see that can qualify for the R&D tax credit? And I've listed some here, and I can add a few more. And these are very general, but it's just to give you an idea of the sort of technical activities and the nature of activities that commonly claim this credit. So you'll see the development of improved strains of grapes or product formulations, prototype batches. You'll see the development of new flavor or aroma profiles, developing soil or rootstock improvement processes. You'll see a lot with plant irrigation systems, the development and implementation of those systems, improved fermentation processes, improved bottling and packaging solutions, even newer improved types of corks, looking at different filtration methodologies, ingredient mixing technologies, ensuring or developing new products or processes to ensure consistency or shelf life, QA testing processes. One I very see frequently has to do with water recycling or water management, wastewater processes, and the development and implementation of those. And another one, very common, again, general, but are green policies or sustainability practices. I know it's a very popular trend in the industry as a whole, and a lot of times these efforts can qualify for the R&D credit as well. So if we know that some or a lot of these activities qualify for R&D, and as you can see, it's quite a wide array of activities. So why doesn't everyone claim these? Why isn't everybody claiming everything? Usually it's a couple of reasons. Either they didn't know that their business qualified, or at least the extent to which their business could qualify for this credit, or they were afraid of the enforcement agencies. And so let's talk about those. As this is a tax incentive, it's governed and patrolled by the taxing authorities. That would be the IRS for federal taxes, and the appropriate state agency if you're claiming a state credit. I believe right now we're at 37 different states that have an R&D credit, each with their own rules and enforcement. But in California, which has a great R&D credit, by the way, that would be the FTB, the Franchise Tax Board, is in charge of enforcement. And just a side note about these agencies, you know, these aren't the evil entities that everyone often makes them out to be. They're just there to make sure you do it properly and you do it the right way and you don't abuse the system. So if you do it the right way and you're honest, generally you're going to be okay. But more on that to come. As far as audits, you know, they do happen. It would be wrong to say that it's impossible to get audited for claiming the R&D credit or any tax incentive. But that's something that, you know, we track in our business and of course industry-wide very closely. And right now I'm seeing typically it's about a 1% audit rate, which is not that significantly different than just typical businesses filing their taxes. About 1% of companies that we see claim the R&D tax credit get a question about that, either on the federal or state level. And then the ultimate success in those, of course, can vary, but it typically depends on the process that was used to properly document and substantiate everything that you claimed. And so we'll talk about some of the best practices there in a moment. But another place you'll see and hear about R&D is from the court cases. Now, I will try my best to keep this short and sweet. Most of the time, if people have trouble falling asleep, I recommend they read tax court cases. But I personally find it very exciting. I know I'm in the minority there, but I'll just try to keep this to some of the major points. But every year, I'd say around 3 to 5 R&D court cases come out. And while they usually aren't monumental shifts in the actual definition of R&D, they do very much change the landscape of the R&D world. These cases can be from anywhere in the R&D spectrum, for how to properly claim it on the tax return, to what qualifies, to how to qualify it, to funding and payment questions, to underpayment of taxes. Anything that has to do with R&D, you can usually find an R&D court case about it. I would say most recently, sort of the flavors of the week, flavors of the month, if you will, they tend to be on the 4-part test. So that's what I was mentioning earlier. So proving that the activities qualify, and then funding, which has to do with payment terms. So anytime you're paid to do R&D type work, or you pay a third party to do R&D work for you. So looking at the contracts that have to do with those types of payments. But there is one recent case from this past year that I certainly want to highlight because it's very applicable here. It's called the J.G. Boswell case, and I love it for several reasons, but mainly because it's an agriculture case, and that rarely happens. You see a case that occurs in the agricultural industry. Happens to be an agriculture company here in California, a large farming business. You may be familiar with the company. And again, I'll try to avoid going too much into it. But the real dispute was the differentiation between a new product and a new process to improve an existing product. And essentially what kinds of expenses can be claimed for the product versus the process, because the rules are different. Both sides made their arguments. J.G. Boswell and their attorneys did, as well as the Treasury Department, essentially the IRS. The court laid out some rules, some clarifications, and then ultimately asked the parties to go back and answer some more questions. So it's an ongoing case, but to me, there were several key takeaways from this. First, it already provides some more clarification for the types of supply expenses that can be claimed by agriculture companies. So think of all the raw materials that can go into new products, that can go into the testing of them, and then the processes to improve those products, test plots, control plots, all of that. So it went into those types of expenses. Second, anytime the IRS has to put forward its defense, it helps us prepare for the occasional audit. We know what their argument will be, so we can gear our R&D study for it and make sure we're gathering the proper information and properly substantiating it. So if they do bring up those types of questions, we're prepared for it. And third, finally, my favorite, this is a huge validation for the agriculture industry. This is both the court and the IRS saying that agriculture qualifies for the R&D tax credit and lays out what types of expenses they clearly believe do qualify. Of course, there is still plenty of gray area and room for interpretation, but neither said that agriculture itself and all the types of businesses and activities don't qualify. And I love this. It's very rare to get such validation, since the tax code doesn't really list out the industries that can claim it. But to have the IRS and the courts both say that agriculture qualifies, very strong validation. And okay, I'll spare you the rest, but this is all just to show how important staying on top of these court cases really are. So what does this all mean? It means that well, first of all, you need to claim this highly valuable incentive, but you also need to claim it properly. You need to be up to date. on IRS trends, on the recent court cases, recent state laws in court cases, and make sure the entire process of gathering and substantiating the credit is all centered around this. A big key to this is tracking. How do you properly track activities and expenses? What do I have to do to track them? Do I have to have time tracking, a labor detail of all my employees down to the minute and hour of what they're doing? Of course, the answer is no. I would say 95% of companies that claim this credit don't have a time tracking system, and they can still successfully claim the credit. But you do need to do it properly. Essentially, what you're looking to do is to make the connection between the generation of expenses, so all the money that you're spending on these activities, and the activities themselves that qualify, and that's how you ultimately generate the credit. You need to take a look at any funding issues that could arise. So again, if you're being paid under contract, or you're paying anyone under contract where research is occurring, you need to take a look at it. And then I always do like to share the guidance the Treasury Department has put out for substantiating the credit. And I couldn't make it up if I tried. They said in order to properly substantiate the credit, you must properly substantiate it. That is their guidance. And so, of course, they don't give you much, but that's what the cases and case law does, is provide some guidance there. Essentially, that there's no magic document to check, no magic box you get to fill in, or you have this document and you get to claim the credit. But everyone should be able to claim it as long as they do it properly. And it's very important, I can't stress this enough, to do a yearly review of your expenses and to what you can claim for this R&D credit. Because as you can see, the rules can expand it or contract it, and what the IRS is expecting can change, and they expect you to do it properly. So it's essential that each year you take a new look at it. All right, and finally, when I look ahead to this year, I can quickly touch on some hot topics that we see coming. The first one is amortization of R&D expenses. This is something that went into effect for tax year 22, so that's the year that just ended, that we'll be filing our taxes for soon. Now, this rule of amortization has no effect on the actual credit itself. The R&D credit is unchanged, and you can still claim it the same way. But it does have an effect on how the expenses that are included towards the credit are treated tax-wise. Now, this is something that you can certainly discuss with your CPA, but it will have an effect on your tax liability, and in my opinion, makes claiming the R&D credit even that much more important to help reduce some of that tax liability. Now, there's a strong push to remove this 5-year amortization requirement. But of course, this is tax law, so it must get through Congress, which we all know is quite challenging at the moment. But in the upcoming months, there is expected to be a push to change how this works. One of those pushes is being led by our R&D Coalition, which is essentially a lobby group, which really helps push to strengthen this R&D credit, made up of some of the very large businesses, Fortune 500 type companies. And their goal really is to strengthen this R&D credit and make sure the U.S. stays competitive on the world market for research. And they're one of the groups that are leading to push for this amortization delay. And they certainly have a lot of resources at their disposal. One last piece I want to touch on, it's certainly not meant to scare anyone, but you may have heard in the past year there was some legislation that did pass to increase funding for the IRS, specifically to hire, I believe it's 80 or 90,000 more agents. And while now, of course, these aren't going to all be R&D agents, and some of that funding is for technology improvements and such, there is likely to be an increase of enforcement across the board. But as I said earlier, this is not meant to scare anyone. The IRS isn't there to scare or penalize anybody for claiming an incentive that Congress laid out to have businesses claim. but it's all the more reason to make sure you want to do it properly. The R&D credit is an incredibly powerful incentive for the agriculture and winemaking industry. It's been around for decades, and it will be around for many more. It's there for you to claim it. But as you've seen, you just want to make sure that you do it the right way. So thank you for allowing me to share, and I will pass it over to Kim at this point.
Thank you, Mitch, and thank you, Stephanie. That was very enlightening. Just a quick reminder again, if you have questions, pop them into the chat, and Stephanie and Mitch will be right there to answer them. I actually had a couple of clarifying questions. Maybe I missed something, but Stephanie, there were two ways to qualify for the incentive, and the first one was the revenue decline. Does it need to be shown that the revenue decline is related in any way, or could it be, I just have a revenue decline and who knows what it's about?
Yeah, that's a great question. And so a revenue decline is a revenue decline, whether it's related, you don't have to prove that it's related to a specific order or due to the pandemic. It could be that during this time period, nobody was leaving the house, sales went down, and therefore you had a revenue decline. Or maybe it was the way that the the invoicing is on an accrual and or on a cash basis. However, it worked out that it could just be that in that particular quarter you had a revenue decline. You still qualify for the credit. Doesn't have to be tied to the pandemic per se on the revenue decline test.
Very good. And then on the second, the shutdown part, do you have to then show some sort of connection between that shutdown effect affecting your business?
That is correct. Yeah. So on the government shutdown order test, as I was mentioning, it's not bright line, right? It's this narrative that is written about how your business was impacted due to this order, right? So because of this order that existed during this time period, these limitations and restrictions occurred to my business, and it's tying that order to that restriction and that financial impact that occurred during that time period. So yeah, it's kind of a multi-layered qualification, if you will. Much documentation and substantiation goes into it versus the revenue test, right, where you're just running strict numbers. It truly is, as I mentioned, that facts and circumstance case.
Okay. And then one more question I saw on one of your slides. There was a bullet point that says, our IRS interviews not enough. And I was like, what does that mean?
Yeah, so essentially, what it should have entailed is just that, when you're looking at how your business was impacted, right, and documenting how your business was impacted, it's really just the documentation behind how the business was impacted. And as I mentioned, that narrative. So a lot of times it could be, because these orders existed, my capacity requirements were I was only allowed to be at a 25% capacity from this time period to this time period. If you don't have that documentation there as to how you're tying that order, right? So essentially saying that because this order existed, I qualify for the credit. It's much more than that. It's much more than just, indicating that there was an order existed and therefore my business was impacted. What percentage of your business was impacted because of this order, right? What areas are we talking about? Are we talking about the physical location? Are we talking about your workforce disruptions? Because workforce disruptions did happen. Businesses were struggling and did have to furlough or lay off or make, adjustments to hours. The operations component, right? So what happened to the operations during that time period? It truly is documenting that. So really, it should just have been the documentation of that narrative versus the IRS interview. It's really the documentation behind why your business, why you're able to claim under the authoritative test, right? What percentages of the business and how were those impacts related to that order?
Excellent, thank you.
Yeah.
And Mitch, I had a couple of questions for you as well about the R&D. So, when you go into an R&D process and try and make improvements, you're not guaranteed success. What if you're not successful in your efforts? Can you still claim this credit?
That's one of my favorite things about the R&D credit is that it's all about the attempt. Whether it's actually successful or not is irrelevant to being able to claim the credit, as long as you have expenses towards trying to undertake some new development process or creating a new product. That's what matters. And so I often say it can be kind of a silver lining to some of those attempts that perhaps didn't pan out or go the way that you wanted. You can actually recoup some of that in the form of the R&D credit. So yes, absolutely.
Great. And then sort of related to the amortization thing. So if you begin a process and it's not completed, you can say, okay, I had these expenses this year and the process continue next year, and you can, or do you have to wait till you're done with the process to do a filing?
Very, very good question. So every year stands on its own because there's an R&D credit. It kind of follows your business's tax year. So all the expenses that say happen in 2022, and any products or processes you tried to develop, those expenses can be claimed in that year for tax year 22. And if it continues on into this year, when you file next year's for the taxes, you can then claim those expenses. So every year stands on its own. It actually makes sense because projects don't start January 1st and end December 31st. They obviously span oftentimes multiple years. And so, yeah, you claim the expenses when you actually have them, when they occur, regardless of how many years the overall project takes.
And then Stephanie mentioned the deadline for the employee retention stuff. What if you missed the boat on the R&D for past years? Can you amend, or is there a deadline for amending past years?
Absolutely. So we very commonly see businesses go back to amend to claim the R&D tax credit, and you can do so typically up to 3 tax years. So right now, for example, most people will be in the process of filing their 2022 taxes. You can actually go back 3 years. So that would be 2019, 20, and 21 as well, and file for the R&D credit. So a lot of companies will look to do the analysis because there is some overlap amongst the years. They'll look to do all 4 years of analysis at the same time, file this year's taxes, and then amend the prior 3.
Great. And then again, Stephanie, she mentioned the cap on the employee retention credits. What about R&D? Are there caps on there that we should be aware of?
There are no caps. The more you spend, the more you can get. And actually, that's a great point. On the federal side, it's roughly an 8% credit. So if you had, for example, $1 million of what was determined to be R&D expenses, you could get roughly an $80,000 federal credit. And then the state would piggyback on that. For example, California is around 7.5%. So you're looking at about 15 cents on the dollar you can get, and there's no cap.
Wow. That could be a nice little addition. Okay, I don't think I have any more questions, but again, if you guys have final questions, put them into the live chat now for Stephanie and Mitch. And Stephanie and Mitch, do you have any final comments you want to add before we say thanks for being part of the conference?
Not for me. Appreciate the chance to be able to share, and yeah, excited to answer any questions. I kind of get oddly excited about this stuff, so happy to answer any you all might have.
Yeah, same. I have nothing additional, but yeah, any additional questions or thoughts, feel free to please push those over to Mitch and myself, and we're happy to answer anything you may have in additional to what we discussed today. Thank you, everybody.
Excellent. Thank you, Stephanie. Thank you, Mitch. Thank you for everybody who joined us for this final session of Bold Predictions 2023. We'll see you back next year.